Okay, good afternoon, everyone. Welcome to the Academy of Finance Fireside Chat. And we're very privileged today to have a very heavyweight speaker, Tobias Adrian. Tobias is the financial counselor and also the director of MCM, Monetary and Capital Markets Department of the IMF. MCM is actually very well known among the central bankers, especially for a very good report that they produce 2 times every year. It's called a Global Financial Stability Report. I think it's probably the most read, or if not, one of the most read IMF publications. I've been reading it for I don't know how many years. And if you have not followed GFSR, I recommend you to do that. Apart from that, Tobias is also the point man in the IMF responsible for global emerging trends like sustainability or digitalization. So we're very, very happy to have Tobias with us today. And today I'll just throw a few questions first on a range of issues for Tobias to share his views with you. But after that, you will all have a chance to raise your hand and ask questions. In fact, apart from the people that we see in this room, you have to be mindful of the camera out there. We've got about 600 people online watching you. So it's a lot more than the group here. So why don't we just start with the core mandate of MCM, which is global financial stability. Last year, I thought the world has seen a lot of surprises. If you roll back to the beginning of 2023, we were expecting a global recession, big slowdown in US economy. It turns out to be a lot more resilient. We were expecting some kind of cracks in the financial system, but we were looking at that time at non-bank financial institutions. It turns out it was the banking institutions in US and Europe that got into trouble. And come this year, how do you see the global financial stability risk around the world? Are there pockets of vulnerabilities or risks that you might be a lot more worried than last year? Let's say people talk about commercial real estate or non-banks in private credit or hedge funds. So what do you think?
Yeah. So let me start by thanking you, Eddie, for having me here at HKMA. It's really wonderful to meet so many friends and engage in conversations about the current conjuncture, both on the financial stability side and on the economic side as well. So to turn to your question of global financial stability, so we release twice a year the Global Financial Stability Report. I don't think it's the most read publication of the IMF. The World Economic Outlook is sort of like the first order flagship, which is about the forecast and really the baseline. And to understand global financial stability, you have to start with a baseline. And I think the baseline is indeed a fairly good one. We do expect a global soft landing, right? We have seen a tremendous rise in inflation, but also a fairly quick comeback down towards target. Not quite at target in most countries, but a return towards target. And it's really the first time, I would say, it depends a little bit on how you look at it, but I would argue it's really the first time that you have seen a major inflation episode that was very broad across the world, followed by a soft landing, right? And I think the underlying reason for that is that the surge of inflation was partially driven by aggregate demand. I'm talking about the global level, but also importantly by aggregate supply. So depending on what country or what region you're looking at, it's perhaps 50-50 or 70-30 or 30-70 or so, but it wasn't only aggregate demand, it was also aggregate supply. And as central banks started to tighten monetary policy, it was not just aggregate demand that was slowing to some degree, but it was also supply chain disruptions, commodity prices, and more generally supply side factors that moved in the right direction. And so that means that the monetary policy tightening may well be followed by a soft landing globally. Of course, there are big regional divergences, right? I mean, you saw more inflation, for example, in some emerging markets in Latin America than, say, in countries like the US or Europe. And of course, Asia had quite, on average, lower inflation than other parts of the world. So here's the baseline. We envision a soft landing, a slowdown of global growth, but no global recession. But of course, global financial stability is not so much about the baseline, it's more about the downside relative to the baseline. So how big do we assess the downside to be relative to this, fairly positive baseline? And so the downside has become smaller. So we are less worried today than we were 6 months ago or 12 months ago. But relative to sort of like a long history, it is still a fairly fat left tail. So there's still quite a bit of downside relative to the fairly positive baseline of a soft landing. And what are some of the reasons for this downside? I think one obvious reason is that we have seen a lot of volatility in recent years, right? In the past 5 years, we have been through a series of shocks, and there continues to be a sense of heightened uncertainty, so there could be a further realization of downside shocks. Secondly, inflation has been moving in the right direction, but of course, there could be unpleasant surprises, and there could be more persistence than what is currently priced in. So we're hopeful that inflation will come down, but there is the risk of more persistence and hence more persistent higher interest rates, and perhaps even some monetary tightening in some countries. So, some central banks around the world have signaled that they don't want to rule out that at some point, even if they have lowered rates already, they may have to raise again. And then finally is the financial sector. And, very happy to go deeper into that. But when we think about a year ago, right, the turmoil in banks in the US and Switzerland that, spread to some extent, at least temporarily, was very much related to interest rate risk, i.e. To the mark-to-market losses on the asset side of the balance sheet of the banks associated with a sharp tightening of interest rates. And as you allude to, today we still have fairly elevated interest rates relative to the recent history, but we also have some increase in credit realization. So default rates are going up to some degree. Again, a lot of heterogeneity across countries and what kind of exposure you have in different sectors. But for example, commercial real estate, in some countries, residential real estate. So it's not only the rates, it's also credit that is weighing on some institutions.
Well, I want to get a sense from you. Well, you talk more about the global risk. I want to get a better sense from you about Asia, emerging markets. I read a more recent blog that you published, which talks about how emerging markets navigate around the uncertainties in interest rates. And if you look at last 2 years, emerging markets, especially Asia, is extremely resilient in the face of a 5% increase in rates in the US, which was not seen before. Usually what we saw was capital flows going out very quickly. How do you account for that? And what are the risks that you would envisage for Asia in particular with the coming uncertainties?
Oh, absolutely. I think when you, again, look back over the past 5 years or so, right, we had the pandemic shock. We had the war in Ukraine, the rise in food and commodity prices, the rise of inflation more broadly. Major emerging markets have been extremely resilient, right? In Asia, as well as around the world. I think that is very closely related to better policy frameworks, right? So when you think back 10, 15, 20 years ago, right, in terms of central bank independence, monetary policy frameworks, financial regulation, FX management, I would argue that at least in the major emerging markets, we have seen, first-order progress, macroprudential tools as well, right? And that's a fairly broadly spread theme. So I remember in the depth of 2020, many forecast, emerging market crisis.
Yeah.
And we were always skeptical about that. We felt that the major emerging markets were probably resilient. And, I think Asian economies have been extremely resilient relative to those shocks. And I think it's the policy frameworks, so the buffers, buffers along many dimensions. So buffers in terms of capital and liquidity on financial institutions, buffers in terms of FX reserves, and buffers in terms of credibility of policy frameworks, right? All of that is, of course, at the heart of what they do at the IMF. We're trying to serve, countries by advising, on how to develop those policy frameworks. And I think the benefits of strengthening the policy frameworks have been paid off in those years.
Right, and obviously the Asian jurisdictions are very good students of the IMF, learning to accumulate the buffers when we have the ability. And like in Hong Kong, FX reserve remain high, capital liquidity ratio remain high. That builds the confidence. It doesn't mean that you will have to use the buffer, but having the buffer itself will already fend off the possibility that you might need to use your buffer. Now, let's get deeper into one or two pockets of concerns of the market. One, of course, China. Yeah. And in your last GFSR report, you talk about the property market in China and the potential risk that there could be spillovers. It's now already like 5-6 months later. What's your latest assessment on China's financial stability risk, and whether, what are the ways or the suggestions that you have to mitigate those risks?
Yeah, absolutely. So we have seen an adjustment in property markets in China. When you think back over the past 10 or 20 years, right, the development of property markets, investment into both residential and commercial property around China have been a tremendous engine of growth, macroeconomically, but they have also been a major source of savings for households, right? And so the slowing of the property sector, is not just hitting the financial sector, it's also hitting households and the economy more broadly. In our assessment, the actions of the government have been, very well targeted in terms of providing support to some degree. Of course, you cannot undo, the say structural transformation, but you can cushion. A multiplicity of measures have been taken in terms of providing support to households, providing support to some of the developers, in particular in terms of finishing some of the housing that hasn't been finished in the case of those developers that filed for bankruptcy. In terms of supporting some of the local governments. So I think that this targeted support has helped cushion and mitigate the fallout in terms of financial stability. Now, having said that, of course, there's some uncertainty as to how much further property prices will adjust, to what extent those losses will be allocated across different agents. So we're watching the evolution very carefully, but as you allude to, we share the assessment that it's not so much of an acute financial stability risk because of these actions that have been taken. It's more of a structural transformation in terms of shifting the growth model and rewiring the real economy. And of course, the financial sector will then appropriately adjust as well.
Right. Well, the other area that the market is increasingly talking about is the debt level. Private debt and public debt has been going up, but surprisingly, in terms of private debt, the non-performing loans around the world, the default cases, seems to be quite under control. But of course, we might have a higher for longer situation. Are we, is it just we're not seeing the worst yet, or is it the corporates getting a lot more resilient than we thought?
So, I would point out that there is a part in the global economy that is already in distress in terms of that. And those are, some of the weaker emerging markets, but particularly developing economies. So here in Asia, for example, we have been working very closely with Sri Lanka, for example, on the program, on the debt restructuring. And, at the IMF, we have this role of being a lender of last resort for countries that are losing market access and that need a structural adjustment. And, many countries are facing those challenges. This is not sort of like systemically important for the financial system, right? But there are many countries that are in distress, and in this sense, we are very busy. But it's not so like the major emerging markets, and it's not the major advanced economies. In terms of pockets of vulnerability related to debt, as economies are slowing down, we see some weakness to more or less a degree across economies, right? In particular, in an adverse scenario with a flare-up of inflation, higher for longer interest rates, and a sharper drop on real activity, there's a weak tail of corporates, there's a weak tail of households, and a weak tail of banks, pretty much around the globe. How fat the weak tail is depends very much on the country. And if you look at the GFSR or if you look at our Article 4s, there's sort of like a lot of detail as to how fat that tail is. How bad is it sort of like in the aggregate? It's probably manageable in the baseline, but we still worry somewhat about the downside.
Right, but talking about that, it's not really just the private debt. You talk about the emerging market public debt, but the public sector debt is also rising globally. In the past few years during COVID, understandably, monetary, fiscal has to be very supportive. Now, the monetary side has already reversed. Do you feel like the fiscal side should come in now in terms of consolidation instead of really going the way that it is?
Yeah, I don't think that most countries need a very dramatic or rapid consolidation. But of course, we do observe that global debt to GDP ratios have been increasing broadly around countries. So that's true in Asia, it's true in Europe, it's true in the Americas, it's true in advanced economies, in low-income countries, and in emerging markets, right? So it's a very broad phenomenon that debt to GDP has been going up. In some countries it's more the public sector, in others more the private sector, but sort of like total debt to GDP has been rising. And of course, that's in an environment where sort of like the global growth rate has been slowing down, right? Again, that's something that we have been observing broadly. Now, in our assessment, the real neutral interest rate remains fairly low. So we do expect that real rates will come down to some degree. But there's some uncertainty as to how big real term premia are, and this is where balance sheet normalization of central banks may become relevant, right? I mean, the first order channel after the global financial crisis to transmit asset purchase programs into stimulative policies was through this term premium channel, and term premia have risen to some degree, and so how persistent that is, I think, is something that we'll watch very closely going forward.
Right. Well, let me move to the second area. I can't ignore this area because we are now still in the Hong Kong Green Week. And Tobias, you also helpfully chaired the IMF HKIMR Asia Climate Risk Platform yesterday, roundtable yesterday. So can you tell us a bit more about the IMF role in supporting the climate agenda and also your approach in assessing the climate risk?
Yeah. So let me start from the big picture and then become more granular. So the big picture is that the IMF is generally working on macro-critical issues. So, whatever has implications for balance of payments from a macro point of view is in the domain of the fund. And of course, climate transition is already macro-critical for many countries and is expected to become more macro-critical, unfortunately, for many more countries. So, it's certainly a first-order priority for us. Now, we are an institution with many thousands of economists, and of course, the first-order policy recommendation in terms of climate policies is carbon pricing, right? The underlying friction is the externality, that we don't fully internalize the kind of impact that our carbon emission has on the world as a whole, and so taxation is certainly the first order. But of course, the degree and the speed to which countries are moving towards carbon pricing, remains somewhat worrisome, and so we are doing also quite a bit of work on climate finance. So. Basically complementing the fiscal with the financial. And of course, Hong Kong has been a leader in terms of issuing green bonds. So, our question is, to what extent can we help the membership, thinking through climate financial arrangements in order to finance the necessary investments for a green transition, both in terms of mitigation and adaptation. I think it's work in progress, but when we look at the aggregate numbers that are necessary for a climate transition, they are in the trillions of dollars annually, right? So the magnitudes that are necessary in terms of investments are staggering, and what is being financed and what is necessary, there's a big gap. And so, working on this climate finance is another priority.
Right. Well, I think climate finance is definitely important. And here in Hong Kong, we are a sustainable finance hub, and we really want to do our part. Not only about linking China and the world, but also about financing Asia. And when we talk to the other central banks and the market participants, for Asia and emerging markets in general, transition is important. And how to finance transition is extremely challenging. We don't have the taxonomy, we don't have the pathways, no definition, and the risk profile is not really acceptable by private market participants. So what advice will you give in order that Asia can actually move better in terms of not just public capital, but also crowding in private capital into transition financing?
Absolutely. So I think the climate information architecture is extremely crucial. So this has really three parts. So one is data about scope 1, 2, and 3 emissions. Secondly, disclosures about that data. And thirdly, the classification, or we could sometimes call it alignment. China has actually been very much forward-leaning in this domain. On the disclosure side and the data side, there are now emerging international standards spearheaded by the ISSB, the International Sustainability Standard Setting Body, which is a sister organization to the IFRS. So we are working through the FSB as well as directly with the ISSB very closely on those data issues. I think on the alignment side, many countries have work to do, but also on the regulatory side. So security markets regulators are working on the disclosure and the data issues, statistical offices. So it is a big lift. So working on the market development as well is very first order. I think it's a multifaceted approach, and Asia has a very big capital market, and there's ample opportunity to develop climate finance further.
And one area that we've been actually discussing with both IMF and RC is how to structure blended finance, so that we can risk tranche the different project loans, so that for example, the MDBs can take up the equity tranche, the sovereign investors can take up the mezzanine, and the private sector can take up senior. I think structures like that probably will help channel more private capital into places like Bangladesh, Pakistan, the less investable jurisdictions.
Yeah, so of course, the World Bank, the IFC, so the IFC is the public-private partnership arm of the World Bank. And of course, the World Bank is our sister Bretton Woods institution that, of course, on climate issues is in the lead, particularly what concerns project investment as well as financial structures. Where the fund is coming in is really from this macro perspective, right? And in that sense, we're complementing the World Bank and the IFC. And we have been doing quite a bit of policy work as well on understanding what kind of financial instruments are working. For example, with the NGFS, we have been working on blended finance. It's a priority in collaboration with those other IFIs to make progress in this area.
Right. Well, I need to leave time for our favorite subject, which is digitalization.
Yes.
There's a lot happening there, whether you're talking about blockchain, AI, and tokenization. So let me start with blockchain-related initiative. The first one has got to be CBDC. Hong Kong has been doing a lot on that. Cross-border CBDC with Project Enbridge. Retail, we've been trying now. Now we will be rolling out a wholesale CBDC sandbox. So how do you see the CBDC movement going on around central banks? Are there particular areas that you think CBDC is helpful, or are there risks that we should be particularly concerned about?
Yes to all of your questions. We view the journey towards CBDC as one that is quite heterogeneous across countries. So, depending on the specific mandates of central banks, depending on the way in which the particular financial sector is structured in countries, different countries may make different choices. So you mentioned wholesale CBDC. That, I think, is going to be adopted more broadly. I can think of at least half a dozen central banks that are sort of like very actively working towards wholesale CBDC, perhaps more. Retail CBDC, I think some countries will go towards retail CBDCs, others will not. But even on the wholesale CBDC side, some countries may not go there either for some time or at least for the foreseeable future. Now, we do see that the vast majority of central banks are exploring CBDC, either wholesale or retail or both. everybody is thinking about it, but what it means concretely in terms of policy decisions, is quite different across countries.
Right. And CBDC is really part of the movement towards tokenization. Then can you tell us a bit more about your thoughts about tokenized assets? Will the financial system move a lot more into that area, or will it not?
Yeah, so we do see benefits of tokenization. We do see benefits of CBDC, but we also see risks and potential sources of instability. So, what we are trying to do is really help central banks around the world think through both the costs and the benefits, and to appropriately, assess both risks and opportunities.
Right.
We don't at the moment have per se a policy line on what is sort of like the optimal framework or so. What we're doing is, thinking or helping central banks think through all the dimensions in order to, get to decision-making process that hopefully will be beneficial for each country.
Right. Well, as we discussed, Hong Kong has been trying out the tokenized government bond. The benefits that we see are like efficiency, transparency. But of course, as you said, there are risks that we are still looking at. And the legal environment for that is not well established yet. So it's actually in a very initial stage, and there's a lot more work that needs to be done, I guess.
Yeah, exactly. And so I think some legal frameworks are more friendly to tokenization than others.
Right.
In some countries, it's easier to pass legislation than in others. So there's really quite a bit of heterogeneity. Technologically, absolutely. Like technologically, there are many opportunities, but that is only one part of the puzzle, right?
Right.
It's the legal underpinning, it's the governance, the AML, CFT, the kind of partnership that the public sector has with the private sector is quite different in different countries.
Right.
The scope for financial inclusion, the need for financial inclusion is very different across different countries. So it's really, yes, absolutely, from a technological and so like conceptual point of view, there are many benefits, but then in practice, there are many trade-offs, and it gets, quite a bit more complicated than so like the pure conceptual that is, of course, very appealing, but the practice is more challenging.
Well, of course, on the one end is tokenizing current traditional financial instruments, maybe real-world assets. On the other end is something that we have been talking about in the last few years, crypto assets. What do you think about the regulation of crypto assets? In Hong Kong, previously we were actually quite strict, but it's not going to go away. And we realized that after many crypto winter, summer, it's not going away. So the approach that we're taking is to put in the right guardrails to make sure that if you're not going away, we'll better regulate you so the investor got some degree of protection. But it's very controversial. Some other jurisdictions thought that we're giving legitimacy to something that's too speculative. So what's your thought on the regulation of crypto assets?
Yeah, so we have been working very closely with the FSB on a policy framework for crypto assets. And so the regulation of crypto assets is one very important block. And this is, of course, where the FSB is taking the relative lead, though we're playing important complementary roles. And then there are the broader policy issues as well. Crypto assets not just have regulatory and financial stability issues, they also have implications for monetary policy, for capital flow management, for tax, as well as integrity, AML, CFT. So it's really a very broad set of policy issues that need to be addressed. And on so like the more macro-ish issues, we are relatively in the lead. So this has been really developed last year under the G20 umbrella in collaboration with the FSB, and the implementation of the regulatory as well as the broader policy framework is really in progress. Hong Kong, again, is really at the forefront in terms of already implementing all of these regulatory issues. But ultimately, it has to be done globally, right? I mean, crypto assets are designed to cross borders easily, so it has to be a concerted effort.
Right.
I do agree that there are costs and benefits. There's speculation, but then again, there's speculation in many other areas as well, right? So I'm not so concerned about the fact that there's speculation. I'm concerned about integrity issues, about customer protection, fiduciary responsibilities vis-a-vis your clients, resilience of infrastructures that are crucial in the financial sector in general, but in the crypto sector as well. So we really hope that we're getting to more financial stability, more consumer and investor protection, and carefully balance the risks and the benefits. And of course, there's also a parallel work by the banking regulators, the Basel Committee, to regulate and insurance regulators and other regulatory bodies to regulate the interfacing of the crypto universe with, say, the banking system or the insurance system, or in some countries, the pension system. So, I think it is, again, a question of striking the right balance. So I think we have come out globally in a very good place.
Yeah, and I think your point about the need for global implementation in a consistent way is extremely important, because crypto can take place anywhere and everybody can trade. And we are currently the co-chair of the FSB regional group, and we will help to really push the implementation to all around Asia, and IMF will play a very important role in that.
Exactly. I mean, the regional consultative groups of the FSB are absolutely key in terms of rolling out this regulatory framework. We had a meeting just last week at the IMF together with the FSB to roll out the regulatory crypto policy framework. And we will be working with all of the regional FSB groups to really get at all the nooks. The IMF, of course, has this broad mandate to make sure that the international monetary system is stable, which is a tall order. But it's really the macro that is our strength. Now, having said that, on regulatory issues, of course, we do these financial stability assessments. So we are assessing countries relative to the international standards, right? And so in the crypto space, we have already started to assess countries on crypto regulations in some cases, and we expect that to be broader going forward. We're also doing capacity development on regulatory issues, and we see a huge amount of demand by country authorities to get help to build capacity to regulate crypto activities. So, this again is very complementary to the FSB. We have the surveillance mandate as well as this capacity development mandate, both of which are crucial to assure the global financial stability.
And the last question I have is that we can't leave the room without mentioning AI these days for any discussion. What's your thought about how best to, while getting the full benefit of AI automation, innovation, while preventing the risk, what's the right balance, and how should regulators think about that, that balance?
So let me say two things. So the first thing I would mention is when you think about liquid capital markets, so benchmark government securities, the largest equities in the world, those are traded in a completed automated fashion to a large extent at this point, right? Algorithmic trading is dominating the most liquid security markets. And that is a process that started 10 or even 15 years ago, right? So it's algorithmic trading, automated, high frequency, that is extremely predominant. So this is one version of artificial intelligence, which is more closely related to machine learning.
Right.
And there were hiccups along the way. So there were the flash crashes back in 2010 in the equity markets, in treasury markets. There were some of those. But fairly minor adjustments to trading mechanisms, to stop gap measures, basically fixed those issues, right? So you didn't need sort of like a broad policy framework. And by and large, even relative to massive shocks such as the pandemic, where you saw massive pricing adjustments, the system has proven relatively resilient, right? So that's the machine learning part. So right. I think we have sort of like an example where, a version of AI has been fairly broadly mainstreamed that is, broadly consistent with financial stability. Now, generative AI, of course, is a whole other issue. And, it is still early days, right? I think everybody has been surprised by the speed of adoption of generative AI. And it's very powerful in some dimensions, but it's sort of like interpolating current knowledge in a very effective way in extremely high dimensional fashion. But of course, it cannot sort of like draw conclusions out of that, right? So the forward-looking, the real intelligence, what you and I would think of as actual intelligence, that's missing at the moment. So I think that, there's huge adoption, there are potentially big gains, and, equity valuations are reflecting those potential gains, of course, but there are also big limitations. So I think that, everybody is watching, so like how this is going to be adopted, what the appropriate policy responses are going to be, but there's also continuous tremendous technological progress. Yeah, so I think that, the appropriate balance in between, so like taking policy action, but balancing that against further technological advances and progress is key. Just to finish that theme, of course, as an organization, we are also learning to use generative AI. On machine learning, we have quite a bit of experience, but in terms of generative AI, it's new, and I'm sure you're going through the same process. So, working through our own internal guidelines of how to use generative AI, I think that is part of the process.
But I do hope that the future GFSR report is still written by your team and not ChatGPT.
Well, let's get back to that in a year or two.
Okay, we've got about 10, 15 minutes left. So let me ask whether you've got any questions. Please raise your hand. Yes, Daryl?
Well, thank you, Tobias, for all the sharing. I have a question on non-bank. So it's kind of a circling to the first question that Eddie had. So within the central banking as well as the regulatory circle, there's a lot of discussion surrounding non-bank. So I wanted to get your perspective, or perhaps also IMF's perspective, about the riskiness of the non-bank sector. And, well, of course, the non-bank is a mixed bag. So within that sector, so are there any particular segments that we should be more concerned about?
Yeah, thanks so much. So, of course, again, the Financial Stability Board has been working very proactively on non-bank financial sector, financial stability issues. And there has been progress in some areas. So I would mention in the past couple of years, there has been an important initiative on money market fund reforms. So, money markets can be fragile in some circumstances. And so globally, reforms have been phased in to make money market funds more resilient. There has been an initiative on open-ended funds. That is work that is still ongoing, but there's certainly quite a bit of progress there already. On core funding markets, so those are the sovereign bond markets that are the basis of all capital market activity. There's also quite a bit of work in terms of making them more resilient and more efficient to some degree. But that is very sort of like jurisdiction specific. So international bodies have a little bit less of a role to play here. In the bigger picture, if you think back 15 years of the global financial crisis, there were many stresses in banks, but also significant stresses in non-banks. And I would argue that we have come a long way in terms of making shadow banking into more resilient market-based finance. So shadow banking was much more about regulatory arbitrage. And I think actually it's the banking regulation and insurance regulation that has really come a long way to mitigate that type of regulatory arbitrage. In terms of market-based finance, there are those institutions in the asset management segment that are regulated by security market regulators. But then there are some institutions that are outside of that regulatory body. So for example, at the moment, we are working on private credit markets. So this is credit intermediation outside of banks. It's closely tied to private equity firms. We have a chapter forthcoming in April where we are taking a close look, just to foreshadow a little bit of our findings there. On the one hand, we do think that more data would be good. It is somewhat opaque, even for market participants. It's difficult to understand, what magnitudes are, what exactly is going on. So having more data collection is certainly a first order. But on the other hand, when you look at sort of like leverage and maturity transformation, the magnitudes of leverage and maturity transformation are much smaller than what you see, say, in banks, right? So, the only reason that banks can have a high degree of leverage and maturity transformation is that they are inside the public safety net, i.e. they have access to emergency liquidity and deposit insurance. And to the extent that private credit is outside of that, there's less of those factors. So, I'm just flagging that it's going to be a fascinating chapter coming out in April.
Let's wait for that. But in terms of non-banks, I think in Asia, especially in Hong Kong, the one category of NBFI that we are most concerned about is actually hedge fund and the disruption that they cause to market. In fact, for Asians, the scar of Asian financial crisis was so deep that I think Norman can talk for an hour on that. that we are actually still looking at the risk that might be, not the risk happening there, but the risk that they're causing to markets.
Yeah, no, absolutely. I think, some jurisdictions regulate hedge funds to some degree. Many jurisdictions don't. But I would argue that the leverage in the hedge fund sector is provided by dealers, right? And so the regulation and supervision of dealers, which are largely part of banking organizations, not always, but oftentimes, the counterparty credit risk management of those dealers relative to the hedge fund sector, I would argue has improved, though there are still holes. So, in recent years, I can think of at least 2 or 3 instances, where, the dealers either didn't manage that counterparty exposure properly, or were gamed in some sense.
Right.
And so, yes, absolutely, there's certainly, it continues to be work in progress.
But I think the Archegos incident was a case in point.
Exactly.
That dealers may not have the full picture.
Yeah, absolutely.
Right.
And of course, there are hedge funds and then there are private offices, right? And so you know, from a regulatory and legal point of view,
it's a bit different.
You know, it's a little bit different. Yeah.
Okay. Any other questions from the floor? Yes, over there.
Thank you. I had a question. So, you know, as you know, in recent decades, we've had quite a lot of, international cooperation and coordination among countries on economic policy, but also on financial regulation, and that has been beneficial. In recent years, there are some tendencies towards deglobalization and fragmentation, and sometimes politics trump the willingness to cooperate and coordinate. Many people understand what that means for the economy. It's not very good. Could you please give your view as to what you think that the implication is of that for financial stability?
Yeah, absolutely. So, let me first argue that you know, at the level of regulators, you know, banking, security market, insurance regulators, I think you see, you know, very close collaboration. And, you know, when you look at sort of like the policy developments of the Basel Committee or IASCO, I think, you know, that continues to advance extremely well. You know, at the IMF, we continue to engage on financial stability issues, you know, in the same manner as we always did. Now, when you look at portfolio flows, so those are allocations to stocks and bonds across countries, there have been certainly some trends that may be related to the broader political context. And there are certainly risks in terms of fragmentation to financial stability. You know, the first obvious one is that liquidity could become fragmented, right? And, you know, capital markets work well when they are liquid and deep and broad. So fragmentation of liquidity is one potential risk. You know, secondly, there could be, you know, abrupt portfolio flows that could be disruptive for countries relative to some shocks. So not closely tied to market liquidity, but tied to, say, political developments or so. So last year, we looked at those issues quantitatively, and we do find already in the data that you know, we can see that fragmentation has an impact on portfolio flows, and that has an impact on the cost of credit intermediation in countries that is, you know, significant, both from a statistical and an economic point of view. So, yes.
Well, I've got a question online that it comes from Wilson Yim. He asked, what could have been done differently by central banks during the collapse of banks like Credit Suisse or Silicon Valley Bank? And more specifically, do you think the lender of last resort regime and the emergency liquidity assistance framework is not working well enough?
Yeah. That's an excellent question. So the one-year anniversary is coming up in about 2 or 3 weeks, depending on which institution you're thinking of. Let me just make the first point, which is that I do believe that we have benefited from all of the reforms that have taken place since 2008, right? I.e., there has been a first-order higher amount of capital and liquidity in the system, and the resolution frameworks have helped, even though we have seen failures and resolutions. I would argue that the fact that we have been doing this work on the resolution regimes has helped. So more concretely, you know, in the case of Credit Suisse, these AT1 securities, which are convertible securities, they were available. in order to create buffers in distress. And the availability of those buffers were first order to get to a place that ensured financial stability without costing the taxpayer, right? That I think is the key, right? So, central banks were very fast and very aggressive in terms of stepping in, but I would argue the net cost for the taxpayer has been very limited, and that is the first order benefit of the reforms. In terms of liquidity, I think an important lesson is that liquidity matters in resolution, right? And that when you look at the exposed reports on the events from last year, I think this is one of the main takeaways, is how to think about liquidity as well as bridge lending in the cases of resolution.
Well, in fact, in terms of the overnight settlement, we also found that banks are not used to actually, or are not as keen to use the discount window facilities for fear of stigma, and to actually encourage them to use the settlement facility without the fear of having a stigma is something that I think regulators around the world have been doing.
Yeah, there's a certain tension, right? Because on the one hand, we don't want there to be excessive risk-taking because the discount window is viewed as sort of like, a standing credit line. So, generally discount window policies says that, these are contingent and day-to-day decisions of whether an institution gets liquidity or not. But on the other hand, of course, we do want them to be used when necessary. So, that is sort of like the difficult conflict for central banks to, on the one hand, provide the liquidity when necessary without inducing excessive risk-taking or so. But yes, absolutely. I think that the functioning of emergency lending has come back into focus. The accounting around liquid security assets, as well as the losses, unrealized losses in most cases due to rising interest rates. So interest rate risk is back on the agenda. I would say that in these financial sector assessments, we always look not just at the regulatory and supervisory oversight, we also look at the emergency preparedness of jurisdictions. So that includes resolution and liquidity provision. And when you look at FSUPs around the world, we do about 14 a year. So, since the GFC, we've done over 100 countries in terms of assessments of, very granular financial stability. They're usually, recommendations on both resolution issues and emergency lending issues that we feel are first order.
I think we have time maybe for one more question, if you've got, yes, over there.
Thank you very much. My question regards capital flows in the region, and more broadly speaking for frontier and also emerging market economies. So one thing Eddie mentioned is public debt, or gross debt is growing on the one hand. This is in terms of gross terms. But if we look at net transfers, so net money actually going to developing countries, it is diminishing. Actually, even there's a negative net capital, basically net capital outflows from developing economies, given that they need to pay old debt for principal amortization and interest rates. And particularly in our region, in APAC, so economies are sensitive to the interest rate differential and other traditional pull and push factors. So what's your view about the prospects of capital flows for developing countries, where countries can get themselves financed? Thank you.
It's in the core of what we do at the IMF. Our first order answer is always fundamentals matter, right? So those are the macro fundamentals. So what is the macro situation in terms of growth prospects, in terms of debt and buffers, which is where we started the conversation. But it's also about policy frameworks, so institutional capacity, the central bank, the debt management office, the regulatory oversight. So I would argue it's the macro fundamentals together with the institutional capacity to sustain a healthy environment that can attract capital flows. I think Asia is such a good example. We have so many countries in the region that have seen a tremendous development in terms of capital markets, in terms of attracting foreign investment, and helping to sustain sustainable and long-lasting growth. And I think many other countries can learn from the Asian experience. Extremely impressive. And I do think, well, we started the conversation, which is, the environment for financial stability, the resilience, and the macro framework is so important to create an enabling environment to attract capital flows.
Well, in other words, keep your house in order and money will flow to you. On that note, let's give a big hand to Tobias for the sharing. Thank you very much.
Yeah,
Thank you so much.